Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, have a beautiful retirement. What could be better than that? I am one of your co-hosts, Ben Barzideh. Of course, as usual, I have with me my esteemed, intelligent co-host, Matt Nadeau.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area. We are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies that are buying everything up these days. We don't like those guys.
Yeah, that's for sure. Hey, and of course, we always want to take a minute, pause, say thank you, and say hi to all of our clients who are listening today. I hope you all had a blast at our client appreciation event that we held. It'll be Friday night, which was last night when you're hearing this. It was wonderful. Shame for those people who are unable to make it, but we always have fun events. We'll talk about them in the future. But again, to our clients who are listening, thank you so much. We appreciate the trust you placed in us, and we love every one of you.
No doubt.
And of course, we have a great show. We're going to actually bring up a topic that maybe you haven't really heard about. That's what we like to do here. Bring up a topic that can impact the economy, the markets. And this one is specifically about NVIDIA's $500 billion deal with financial firms. And we're going to talk about how that may invoke some maybe haunting memories of the 2008 financial crisis. You don't want to miss that. And then at the second part of our show, we're going to talk about a tax gift the IRS gave us. They still haven't taken it away. It's fantastic. It's called the Step Up in Cost Basis. You don't want to miss that.
And then, as usual, before we start, we encourage you to like and subscribe to our YouTube channel on moneyhourradio.com. That way you will get our episode as soon as it comes out. You won't miss it. Please also subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's informative, succinct, easy to read. You get a really good idea of what we're seeing, what we're analyzing that week. It's completely free, of course, and you can sign up for it at bnwealth.com. All right, Matt, let's get into it.
All right. So we're going to talk about NVIDIA, and it seems like they are the poster child of everything that's going on in this market. And so if we go back late on Monday of this week, and it was after the markets were closed, there's various financial firms that confirmed NVIDIA's announcement of a $500 billion capital pool to actually help fund their customers so that their customers can buy more NVIDIA chips and processors. And again, like most NVIDIA-related headlines, markets welcome the news. And again, this isn't something that received as much coverage this week, like obviously Iran or CPI and inflation. But the reality is, this headline is probably even more important than all of those others. And that's because AI earnings and the capital expenditures that they're spending is really the driver of this bull market. And that deal with NVIDIA can be viewed as a positive, or maybe you step back and say, is this a warning sign of a bubble?
So for clarity on what happened, what occurred. So NVIDIA announced a $500 billion lending partnership with some major U.S. money management firms. Firms like Apollo, BlackRock, Blackstone, Goldman, KKR, and others, all the big ones. Essentially, NVIDIA will work with these companies to provide financing to NVIDIA customers to buy NVIDIA equipment. So the financial firms will provide the capital from their clients, and NVIDIA gives that capital to their clients, and the money is secured by NVIDIA equipment. Say what? Is that good or bad? Some could say it sounds like a Ponzi scheme or something. And as we mentioned before, there is a positive way to view this and a negative way to view this, and we're going to give you both.
Yeah. Like, this is just, well, I like to do the positive, Ben. I'm gonna be the one that says all the good, the love, and this is because, the positive for the markets broadly is because this AI capital expenditure, the spending, is the driver of the bull market. And it increasingly impacts the broader economy. So this ensures there's actually more fuel to the fire it can ensure that there's this ongoing supply of capital for these tech companies to go out and spend to continue to build out all this beautiful AI. So NVIDIA finds this specifically like great, and it's bullish for two reasons for them. First, it reduces the pressure on NVIDIA to use its own cash, to vendor these financing. So meaning giving money to customers to buy its chips. And instead, it can use the clients of these financial firms to take the risk.
It's like that saying, spread the love. Well, in this case, it's like spread the risk, right?
Spread it.
Okay. So, and then the second positive is that it makes buying NVIDIA chips more compelling because they can offer financing. Think of it like choosing a car brand because they offer the lowest interest rates. And the positive view on this rests mainly on NVIDIA ensuring more of a supply of capital for tech companies to continue the AI build out. Now, the negative view is this is a big alarm, big bell on the lack of AI investment providing a timely return on income. Here's what we mean. Building out AI infrastructure is demanding so much capital, yet providing so little in return that NVIDIA, which is the biggest and most valuable company in the world, is having to go to all corners of the market to find money for its customers to spend to buy its chips and processors.
Yeah, and it's as we've seen so many other times in bubbles, like financial firms are basically rewriting the rules to meet demand and chase return because they're willing to lend money to NVIDIA customers because the collateral for these loans are the chips and servers. And here's the problem, of course. Let's say that the loans go bad. That's actually ends up because now nobody really needs these chips or servers. So the value of this collateral will plummet as well. So it's just a result where loan losses will affect the financial sector as a whole and not just tech in this scenario. So it's like you start scratching your head and like, Ben, where have we seen that before? Bad loans affecting Wall Street. Oh, yeah, the financial crisis of 2008.
Oh, gosh, you're giving people PTSD, man. Bottom line, this isn't just vendor financing anymore. And we talked about that many times in the past year about the vendor financing, that concept where all these AI companies are paying their customers to buy their stuff. It was very reminiscent of Lucent Technologies and the 2000.com era before that bubble burst. So capital needs continue to be so intense. And this is risk of all of the stuff we're talking about here is that it's spreading the risk of an AI bubble further across the economy. So our view here for now is that the bullish case is right on this because the money will fuel further AI spending, which is good for the entire economy. But of course, the negative view is not unreasonable. And this is the type of thing that we may look back on in a bubble burst and say, what were they thinking? How did we not see this coming, right? What everyone says afterwards. But semiconductors and processing power were commodities prior to the AI boom. So using them as collateral for loans from non-tech investors is the type of thing that makes a bubble burst spread beyond just the industry. So it should not be ignored. And of course, we're not ignoring it. We will be watching things very closely and we'll let you know, our listening audience, if it turns into something that you need to be concerned about.
Yeah. And again, we bring this to you because we hear out there that most of the people working with advisors aren't hearing about this kind of stuff. And so the question is your advisor talking to you about this? I mean, do they actually bring you analysis like we do? And do they actually have a backup plan to do something about it in case the market crashes? So you don't have to settle for that. Your money is obviously too important to you. So do you want to work with a knowledgeable advisor, somebody who has a dynamic investment strategy and looks to capitalize on changing trends? Well, guess what? We offer one. Of course, we're referring to our actively managed tactical investment strategy. We call it Advance and Protect, which is the way we manage our clients' portfolios. And that's where we utilize sophisticated research using quantitative and technical analysis to actually measure the dynamics of the market under the hood and then do something about it. Because when the risk in the market is low, we want to be fully invested in stocks, and we'll intelligently diversify into areas of the market that our research is saying has momentum and strength. And we want to avoid areas that are deteriorating.
However, because we monitor our investment positions every single day, we can quickly react if necessary. So if the market conditions do deteriorate, we will get defensive by actually selling out of the stock market and going heavier into bonds or cash while we wait for things to improve. We'll actually do something about it. And there are times we will literally be 100% out of the market if the conditions warrant it. We do not believe in riding potential market crashes all the way down in retirement. Do you have someone watching your money that closely? If our investment philosophy resonates with you, give us a call to explore becoming a client. You can reach out to us at bnwealth.com or call our office at 847-780-2980. All right, don't go away, because when we come back from break, we're going to talk about a step up in cost basis, a valuable tax gift from the IRS for your heirs.
Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have with me my esteemed, wonderful, amazing co-host, Ben Barzideh.
Hello, everyone.
Now, we're both founding partners, wealth managers at Barzideh and Nadeau Wealth Management. It's a comprehensive financial planning firm. We're located right here in Barrington, and we're here to serve the greater Chicagoland area.
And as usual, before we start, we want to encourage you to subscribe to our YouTube channel called moneyhourradio.com. That way you won't miss an episode. And also, please subscribe to our weekly economic commentary. It's called the 5-Minute Market Brief. It comes out each week. We talk about what we're seeing in the economy, what we're doing. It's such a good market update, and it's completely free. You can register. You can sign up for it at bnwealth.com.
All right. Well, and one thing I want to point out, we do this market commentary. If you tuned into our radio show earlier, we're talking about markets and economy. But, one of the big things we do is we do tax, strategic tax planning, estate planning, and we do full financial planning and wealth services for our clients. And I want to talk about one of the most valuable tax gifts from the IRS for their heirs. And it's called the step up in cost basis.
Did you say IRS and gift in the same sentence?
Yeah, no kidding. It's like, hey, they're going to take it away eventually. We'll just keep taking the gift while they'll give it to us. So one of the most common questions and concerns we actually hear from people revolves around taxes that they may have to pay when inheriting an asset from like a parent or a grandparent. And they're very confused about the process and the possible taxes that are owed. And oftentimes we hear something similar to like, well, obviously, if there are any gains on anything I got from my parents, that's going to be taxed, right? I know their house has gone up a lot since they bought it 50 years ago. It's just going to crush me with the taxes. And they have the right to be confused because it is actually one of the more complex areas of personal finance.
For instance, there are all different type of assets and accounts that parents can own, and many of them have different tax rules. For instance, IRAs are taxed differently than after-tax brokerage accounts or property. Non-qualified annuities have their own set of rules and tax implications. Trusts and charitable gifts can be taxed differently. Matt, it's enough to make one's head explode, right? So today we want to talk about one of the most valuable tax benefits the IRS gives you and our kids, which can save your heirs a ton of money on taxes. And it's truly, like you said, Matt, a gift from the IRS. Once you learn about it, you might say, that sounds too good to be true. But guess what? This is one of those rare times in life that while it does sound too good to be true, it is actually true. Say what?
Yeah. And we mentioned it before. The name of it is called a step up in cost basis. So let's talk about how it works and why it's so powerful. So when someone passes away, the assets they leave behind may receive an important tax benefit known as this step up in cost basis, which can actually wipe away the taxes on gains, usually up to the date of death. So for heirs, what happens is this can significantly reduce and sometimes completely eliminate capital gains taxes when inherited property or assets are sold later. But it's also one of the most commonly missed tax benefits because it's either overlooked, poorly documented, and if it's done wrong, these heirs may completely end up missing it or end up paying more tax than is even necessary.
Gosh, Matt, how many times have we seen that in this situation where we talk to a
Sadly
new
enough,
person,
yeah.
they come in, we look at their statements, we talk to them, and we find out through our conversation that they had a parent that passed. And we ask them, hey, did you get that step up? And they go, say what? And right then we know that they didn't.
Yeah,
So
I know.
what is a step up in cost basis? So your cost basis is generally the amount used to determine your taxable gain or loss when you sell an asset. And for an investment, it's usually what you paid for it, adjusted for certain events such as improvements, depreciation, or other adjustments if it's a property. And when you inherit property or an after-tax investment accounts, however, the tax rules generally reset the basis to the asset's fair market value on the date the owner died. And this is commonly called a step up in basis, although the basis can technically go down if the asset has declined in value. So by the way, this is why if someone is terminally ill, they want to look at which assets they have that are down in value and sell those while they're still alive to lock in those capital losses, which can then potentially be used to reduce certain other taxes. If that is not done, once someone does pass, those depreciated assets will get what's called a step down in basis, and the potential tax deduction is gone. So that's the opposite of what you're trying to achieve.
Yeah, step down's a bad thing. So it's easier if we look at an example. Let's look at just a common, simple example of how this is treated. So let's just suppose a parent purchased stock decades ago for $50,000. And at their death, it's been years, so this stock is now worth $300,000. And if the heirs inherit the stock, the heirs' basis is generally $300,000 rather than what the parents originally paid for it at $50,000. It's like, boom, all of the taxes forgiven and wiped out. And if the heir immediately sells that stock, let's say it's now $305,000, the taxable gain in this situation is now only $5,000, not $255,000. That $250,000 of appreciation that occurred during the parent's lifetime is effectively just removed from their capital gains calculation. And this isn't just for stock. The same concept applies to real estate. And we've seen a lot of this as homes purchased years ago, like an example for $150,000 might be worth $600,000 when the owner dies. If an heir inherits it with a $600,000 basis, right, the step up to that $600,000, and as they go through time, they finally sell it for $625,000, the starting point for that gain is that new basis, $600,000. Do you see why, like we're saying, this is almost too good to be true, but it's true. It is.
No doubt. So how are step-ups, how are they commonly missed? How do people mess this up? And like I said, we've seen it all the time. One of the biggest problems is simply not knowing the rule exists. Most of the time, in our experience, families may assume an heir inherits the deceased owner's original purchase price. That can produce an unnecessarily large reported capital gain. Or they just didn't keep good records. That's a big one too. So 20 years later, someone asks, hey, what was this property worth on the date grandpa died? And suddenly everyone becomes an archaeologist as they're digging through boxes in a basement looking for a 2007 appraisal, right?
Jeez. Yeah, that's one of those challenges. You're digging through all of the mess that's left behind, right? Oh my goodness. So what happens too is we run into these issues if you wait and you figure out this later is failing to obtain a date of death appraisal. And that really becomes an issue for like real estate, private businesses, or collectibles. So something that's out there that doesn't have like an obvious, like publicly traded market price. So years later, it gets more difficult to reconstruct what the property was worth on the date of death. And here's another big one that's common. A problem can occur when the heirs sell inherited investments and the brokerage account continues to display an old historical cost basis. So the beneficiary should not automatically assume that the number that is shown from your custodian or your brokerage statement is correct. You want to take a look at the basis and verify it against like the estate's records and any potential applicable tax documents. And then finally, families just sometimes overlook assets simply because they're held in like unusual forms. So like sometimes we see these in closely held businesses, partnerships, investment trusts and accounts that are a little more unusual. So you want to have every situation carefully reviewed to make sure you're not missing any of these opportunities.
And other considerations. So a step up is not automatic for every transfer at death or every type of property. There are important exceptions, including certain property transferred to the decedent shortly before death, maybe community property rules. They can also produce particularly favorite basis results for qualifying property. It is also important to distinguish inherited property from property that was gifted during the owner's lifetime. Gifted property generally follows different basis rules and may not receive the step up in basis. So for that reason, executors and heirs should maintain appraisals, purchase records, estate tax documents, brokerage statements, and other supporting documentation. So be organized.
Yeah, and don't hear this episode and then just immediately think, all right, excellent, everything I'm going to get tax-free, inherit it all. It's not how it works, right? The step up affects, generally capital gains basis. It doesn't mean that the asset itself is magically free of every possible tax. There could be estate taxes, income taxes, property taxes, depreciation recapture, and other rules that could still enter the picture depending on the assets and circumstances. And like, for example, Ben, like IRAs, they don't get this. It's not capital gains. So
Correct.
It's important you work with a professional who knows all these rules and can plan for it. And with any financial planning, investing, tax planning, estate planning strategies, it's important to work with a qualified professional who understands these concepts. Usually a good financial planner like us acts like a quarterback and helps coordinate with your CPA, attorneys, and yourself to make sure everything's in place. So again, if you're in need of a good financial planner, want to have your potential situation looked at specifically, give us a call. We're at 847-780-2980 or go to bnwealth.com and we'd love to take a look and try to help you. Anyway, we're out of time and we'll see you all next week.
God bless everyone.